Good morning. This is Barry Knapp with Ironside's Macroeconomics. It's 6 a.m. Mountain Time on Monday morning, June 16th. Sending out this video to all subscribers today. I don't have time to do two different ones, one for our paid subscribers and one for our free subscribers. I've got to drive down to Denver Airport and fly to LaGuardia today for a week in New York City and a weekend in New Jersey. Hard to leave Vail, the weather's spectacular here, but nonetheless, that's what we're going to do. This is, of course, all about our note this week, which was titled Disinflation Resumption. Tried to think of something a little catchier, but the bottom line is this was a little bit less about policy this week and a little bit more about the inflation data we got last week. We did, of course, receive our fourth consecutive softer or cooler than expected CPI report and fourth consecutive cooler than expected PPI report. And there's a real significant message in all of that and some serious implications. We've talked about three schools, or we did in this note, talk about three different schools of inflation thought. There is, of course, those, and we originally had this note titled Chicken Little for the economists that kept telling us the sky's about to fall and tariff-related inflation was going to just overwhelm the economy, even though the markets never pointed to that. In fact, we again showed at this point, a chart you're probably getting sick of, the decomposition of the twos, tens curve, where we show the real rate curve and the break-even curve. The break-even curve, as was the case in 2022, essentially discounted the peak in inflation or a period of disinflation before it occurred. That break-even curve got deeply inverted at the April lows in the stock market, saying that any inflation effect was likely to be transitory. And it's somewhat disinverted now, but the bottom line is that curve really nailed it. And the markets nailed it by saying that the pandemic was far likely to be a disinflationary shock than it was an inflationary shock. That is to say, the impact on growth would likely be greater than the impact on inflation. So I'll come back to that in a second, but those three schools of thought are inflation is in the pipeline. Just wait till the June or July numbers. The second school of thought might be disinflation has resumed despite tariffs. And then there's the third school of thought, which is really our way of thinking about all this, is that the tariffs have actually intensified the disinflation in as much as they've had a negative impact on consumer demand, and they've put downward pressure on other prices. Now, this is an important background for us, which is inflation is always and everywhere a fiscal and monetary phenomenon. So let's just step back and think about the conditions that persist today versus the conditions that persisted in 2021 when we had our last supply shock. And we could consider tariffs a supply shock. They are a tax on imports. This is a supply shock, just like shutting down supply chains in 2021. China's zero COVID policy was just an epic supply shock. So M2 growth is 4.4%, 4.45% to be precise. Since it started being calculated in 1960 or so, the trend growth rate is 6.66% for M2. So it's growing below its long-term trend. In 2021, early 21, it peaked at 26.7%. That's M2 growth. Let that sink in for a second. Then let's consider the fiscal impulse and government spending. In 2021, government spending was running at 29.75%. It's now running at 23.4%. We've written almost ad nauseum about how that's too high historically. We need to get back to 20.3%. But it is far lower than it was in 2021. No checks are being sent out to anyone. If anything, we're looking at real fiscal contraction at this point. And so at least relative to where it's been during the Biden budget blowout period. Sorry to pick on President Biden. So we do not have the fiscal or monetary backdrop to create a rise in inflation based upon a tax on imports. That just doesn't make any logical sense to us. And in fact, the numbers don't support it. And here we are 4 months in. And by the way, just denying that this has even hit the economy, it doesn't make any sense, because in the month of May, and we got the budget numbers last week, revenues are absolutely surging from tariffs, and they've already reached the level that the CBO projects and other experts project could persist, some $250 billion per year over a 10-year period, more than offsetting, any revenue aspects of the budget. They've already reached those levels. So they are hitting the economy already, and prices are not going up, particularly in goods. So let's just look at Chair Powell's inflation framework. Rent of shelter printed 0.26% last month. It is well on its way to returning to its pre-pandemic trend of about 3%. We've had a bunch of 0.25 prints over the last 6 months or so. We had a couple of quirky ones, but it's well on its way. When we look at the new tenant index that feeds into rent of shelter over time, there's no question that it's headed there. All the subcomponents have already returned on a trend basis to pre-pandemic levels. Supercore inflation, non-housing services, has returned to its pre-pandemic trend of around 2.5%. Goods prices have returned to their pre-pandemic trend of Senator Blutarski's grade point average 0.0. Even though those are the direct impact of tariffs, yes, they're a little higher on a PPI basis, but on a consumer goods basis, they're running at zero. They were slightly negative last month. So this may be absorbed in margins, which is an important factor because we're going to get into earnings season in another month's time. And that for us is the most likely catalyst for a bit of a gut check pullback in the equity market, is that yes, some of the tariffs are being absorbed in corporate margins for consumer-facing companies. That's why we're underweight staples and underweight consumer discretionary. But at this point, there is no impact on core goods prices. And what they're really reflecting is the massive overcapacity in China, the rest of Asia, and the fact that they've just got nowhere else to go. So the tariffs are being absorbed. So let's just consider the quarterly rates with just how soft inflation has been and the resumption of disinflation. All item CPI on a 3-month annualized basis is 1.01%. Core, 1.69%. Rent of shelter, 3.5%. Supercore, non-housing services, that is, 1.46%. And goods, minus 0.28%. Disinflation has resumed. So, stepping back from all this, the Fed should be looking at this. They should not have a 2% target in our view. They should have a stable prices mandate. That's what the Humphrey Hawkins law suggests that they should do. The annualized standard deviation of CPI right now, all item CPI, is 26 basis points. The average since 1947 is 58 basis points. CPI is 2.38%. The average since 1947, or median, I should say, is 3%. They've achieved stable prices. Pressing any further here, continuing to keep the short-term policy rate restrictive is only putting pressure on small banks, small businesses, real estate developers, exacerbating the housing supply crisis when we have this big demographic boom where millennials are reaching household formation age and can't buy a home. This is bad Fed policy in our view, and they should be easing that policy rate. They should be continuing to unwind their portfolio, but again, maybe we'll talk more about that next week after the Fed meeting. So, previewing the Fed meeting this week, this is a summary of economic projections week, so we're going to get their forecasts. Their forecast at the March meeting for the personal consumption expenditure deflator is 2.7%. It's running 2.2% through May. That implies a 3.05% rate for the balance of the year. As a note, that is 62 basis points above the 2-year inflation break-even rate right now. So maybe they'll keep it there, but it doesn't make any damn sense. And that would put the Fed in that first category of just wait till June and July, it's coming. Um, the focus on the first order inflationary effects of tariffs is nonsensical. The market said that's not going to happen. The soft data, so-called soft survey data that came subsequent to that said that's not going to happen. And now that the hard data, price data, inflation data is coming through, it ain't happening. So they should be cutting their inflation forecast. We'll see. They should be raising their unemployment rate forecast. We've been getting steady increases in the unemployment rate persistently since January, when we got that really strange 2.9% increase in the population that should have happened a year before. When BLS suddenly decided in 24 that the size of the working population had gone up by 2.9 million people, they were about a year late on that. The year before they said it shrank, which made no sense because the big immigration surge, as we all know, was in 22, 23, not so much 24, and clearly not 25. So the Fed should be raising their unemployment rate forecast, and they are at risk of missing on both mandates. They probably will not. I mean, they should sound more dovish, but they will probably not signal a possibility of a cut in July. But if they wait till September, by the time they see the first estimate of the annual benchmark revision that we think is still overestimating small business employment, the Fed could very well be cutting 50 in September, or should be at that point. So let's move on to the markets real quickly. I'll try and wrap this up. This is going a little longer than I had hoped. The first thing we wrote about with respect to the markets was a section called Who Will Buy Our Bonds? And we wanted to give just some perspective because we've been in the big structural bond bearish camp. But several weeks ago, we made a call that we didn't think we were on the verge of a crisis, that one big beautiful bill was going to really trigger a broader crisis, that we were really just moving from a period where we had had 2 decades of price insensitive buyers in our treasury market. Now we had price sensitive buyers. We needed a higher term premium to be able to clear the longer term part of the market. So let's just look at the market by segments. The bill market is going to get an even bigger buyer base. Although the Treasury is issuing more bills than the Treasury Borrowing Advisory Committee suggests they should be in periods other than a recession or some sort of funding crisis, they're going to get a much bigger buyer base from stablecoins. The success of the Circle IPO, the talk of Walmart and others forming their own stablecoins, they're going to be buyers of bills. So that combined with the loosening of the supplementary leverage ratio for the banking system will allow them to hold more bills. And you should see plenty of demand for those bill auctions. We've seen that all along. Anyway, the belly of the curve should be supported by the banking system when we see the bank regulatory loosening that's coming, the loosening the supplementary leverage ratio. Also, when the Fed starts to ease, as they well should, that'll steepen up the yield curve. We've seen big banks buying treasuries. We'll see smaller banks buying treasuries and mortgages in particular. Mortgages are super important for the pricing of the long end because of that prepayment convexity risk. The long end needs to find the right price to clear. We don't think that price is below a 4% yield on 10s. It's probably somewhere between 4.5 to 5, maybe 4.5 is a good level. That was our year-end target, but it's going to need to clear based upon household demand, and households have plenty of assets. We've shown that chart. It's in the weekly again to be able to buy long-term treasuries, but it needs to be at a reasonable price. So the other things we covered in the note, we covered this change in the dollar, direction of the dollar from being driven by Fed policy to potentially discounting a real structural change in global current account and capital account deficits and imbalances. We'll leave that to, please read it in the note. Then we went through our performance review thus far this year. We remain very much interested in the Gen AI thesis, although we can't really be overweighted just because it's expensive. The market's all in on it. We have a healthy exposure to tech and comm services as a consequence of that. We think that our recovery in capital investment is on track. We're going to see the first two regional Fed surveys this week from New York and Philly. We expect to see more improvement in business confidence, capital spending plans. And we would continue to avoid the consumer-facing companies because of the impact of tariffs, and don't have any interest in defensives. We think the next potential roadblock for the equity market could be earnings season. We'll have more to say about that in the coming weeks. Barry Knapp from Ironsides. Have a good week, everyone.